Good morning, everybody. Welcome to today's Morning Blast. It is, what day is it? It's Wednesday, the 11th of February. It is non-farm payrolls day. Yes, it's Wednesday, not Friday. You join myself and, of course, Michael for the Morning Blast, where we look to give you a very candid market update, what's going on, what we think's happening, a few rants. The usual disclaimers apply. Nothing said on this podcast is trading or investment advice. Nothing we say should be taken with any relevance whatsoever. Usual warnings for expletives, etc., etc. Michael, how are you?
Yeah, very good morning to you, Ryan. Good morning, everyone. Happy Jobs Day. Still feels very odd saying that on a Wednesday, but here we are.
It is the second.
Yeah, I'm all right, thank you.
It is the second Wednesday Jobs Data in a couple of months, though.
I know. I still don't like it.
No,
as you well know more than most, I am a very much a creature of habits, and it's thrown all my normal routines out.
Creature of habit is one way to say high dependency on alcohol, but yes, I feel you.
You're just still jealous that you didn't get invited to lunch yesterday.
I am very, very jealous. But moving swiftly on, because you've now just upset me, let's crack on. An update from our good friend Clive Lambert over at Futures Techs for market rundown, prices, levels to watch, etc., etc. Starting off with the S&P as usual, is struggling to see off that 7,000 for now. The all-time high remains up at 7,043. It was a quiet day yesterday on this side of the pond.
Oh, don't use that word.
What?
Oh, you just that Q word just tempts fate.
Yeah, but this is regarding yesterday, so I think it's fine. So, but it was a not busy day yesterday on this side of the pond.
That's better, thank you.
Oh God! In equities, with doji candles posted in the DAX, Eurostoxx 50, and the FTSE. Bund futures, German bonds finally saw some resistance at the 128.58 level, hinting at further upside potential going forward. Dollar yen saw red again yesterday and is now offered overnight down to 152.80 as Clive went to post. Bitcoin is back below 70,000, so could well test 58 to 60,000 support level. Gold, the yellow metal, fell shy of 5,114 again. And this and 51.58 are the next levels of resistance to watch above here, and we can head back to the highs of 56.27. Silver is bid again this morning and might be setting up to test 84.74. Above here, we look at 97.61, then back to the recent highs. Fingers crossed, touch wood. Palladium is also trying to recover, but 1767 to 1775 is still weighing on that one. Copper, Dr. Copper is back above 13,030, so that should cheer the bulls, but it hasn't just yet. Brent and WTI both posted doji candles yesterday. We're still looking for a return to the recent high of 70.58 in Brent and 66.48 in WTI. TTF, so that's Dutch gas, European natural gas, saw red yesterday, getting down to 31.60 after gap resistance to 34.10, capped early on 31.73 as a Fibonacci level in play this morning. EU carbon markets also saw some red yesterday and it started today in a similar vein, back below its 200-day simple moving average, which suggests further downside. In ag space, soybeans caught a bid yesterday, so not confirming last Friday's reversal candle. 11.16 is the Marabou support in that one, a level to watch on any dips today. Soybean oil is eyeing big resistance at 5.80. Just anecdotal regarding energy markets. Energy industry must be absolutely booming in Europe because I can confirm it's Energy Week, and the Stafford last night was absolutely fucking heaving with people regarding Energy Week and various meetings.
Hang on. If it's Energy Week at the Stafford, why on earth's Clive in Germany? Did he not get the invite?
Very good question. one of his birds ain't over there, is it? No, that's
just over the border.
Right, quick, move swiftly on before I get throttled. Michael, what happened yesterday?
Sorry, let me compose myself for a brief moment. Sorry, Clive, if you're listening.
Oh God,
I'm not really.
I'm just quickly blocking him on WhatsApp so he can't hit me.
Yeah, I think that might be best. What happened yesterday? Well, to be honest, not a lot, as the roundup from Clive just kind of alluded to. I think most people just sort of sat there all day going, is this thing on? Although, let me be very, very clear, I'm not complaining about that. It's been an incredibly choppy 3 or 4 weeks for markets. I think everyone was quite glad to take a bit of a pause for breath. Having said that, we did get some soft-ish US data yesterday. The December retail sales report pointed to sales having stagnated over the festive period, well short of the 0.4% increase that had been expected and the 0.6% increase that we saw in November. Of more importance than that is the control group metric that was down 0.1% on the month. Again, well short of expectations, and that's broadly representative of the basket that feeds into the GDP numbers. So downside risks for that Q4 GDP print, which were already pretty chunky, if you bear in mind that it's going to be skewed lower by the government shutdown. Do bear in mind that we get the January retail sales figures next week, so they will be a little bit more timely, having also been delayed as a result of that shutdown that I just mentioned. And we did have the weekly ADP payrolls report. That was a little bit soft, pointing to jobs gains of about 6,500 a week in the 4 weeks to the 24th of January. So again, flagging the sort of fragile nature for the US labour market, which we will get onto in a short while. Besides that, on the trade front, we had the White House overnight. This is actually quite interesting, releasing a fact sheet.
When you normally say this, it's normally a sign that it's going to be the most least interesting thing of my day.
No. This is actually interesting.
Okay, go on.
And annoying. Do you know what? And even more annoyingly than it being interesting, it's actually going to prove you right about something. So you might want to listen. Of course, the US and India agreed a trade deal last week, I believe it was, or maybe the week before. The White House have now released a fact sheet summarizing all of the various details of that deal. And importantly, the wording has been changed. So last week, or whenever this deal was announced, Trump was touting how India are going to have made $500 billion worth of purchase commitments. The fact sheet that was released overnight says that India has made an intent to make $500 billion worth of purchases.
I told you.
So it's not we promise to, it's we promise we might do.
I told you, it's letters of intent all the way down.
Indeed. So there you go. It is actually interesting.
Well,
moving away from it's a low bar. Moving on from that, in the geopolitical arena, of course, tensions between the US and Iran are continuing. Trump speaking to Axios yesterday saying that he might send a second aircraft carrier to the Middle East. The USS Abraham Lincoln is already in the region. Looking at all of the various sort of military experts who have analysed these comments, a lot of them are saying it would take somewhere between 3 and 5 weeks to get another carrier to the Middle East. So that may potentially, at risk of sort of putting 2 and 2 together, that may explain why Trump is kind of going down the diplomacy negotiating path, just because they don't have enough resources in the region just yet. I'll stress, I'm not a military strategist. That's from what I've read. On a similar note, the Wall Street Journal yesterday reporting that the US has reportedly been mulling seizing tankers that are carrying Iranian oil as a way to pressure Tehran. Thus far, they have held off doing that over fears of retaliation, but it looks like that could be the next sort of step in this game plan. And a couple of other bits and bobs just to mention before we move on to the jobs report today. On that note, actually, we heard from Trump's trade advisor, Peter Navarro, yesterday. He was on Fox saying, and I quote, "We need to revise our expectations lower on monthly job numbers." Now, call me, put your tinfoil hat on, but on Monday, Kevin Hassett comes out and says that. Tuesday, Peter Navarro comes out and says that. Today, Wednesday, we get the jobs report. I would argue that they're kind of rolling the pitch for the jobs report to be a little bit soft. So do just bear that context in mind in terms of what we'll discuss in a little while. And a few bits of equity news. We have reports via the FT this morning that Elliott, they have built what they are calling a significant stake in the London Stock Exchange Group. This is quite an interesting one. Obviously, Elliott, activist management firm. One of the things that they are proposing is that they want LSEG to embark on a significant share buyback. Fair play, but I'm always quite skeptical of buybacks. They put the money into the company and make it actually.
On this, I do wonder. Our good friend Liam, hi Liam, if you're listening, he did put out a little blog piece he started, which nice little blogs he's putting out. Much love to Liam. He did say a few weeks ago, I think it was, perhaps what LSEG needs is someone to come in and split them up. And I think so far we're going in that direction because we do need to kind of have a massive shake up on the stock exchange side, considering like the private market side, etc. So it'll be an interesting one to watch because as we've said many times on the show, something needs to happen. Whether or not it's just share buybacks, I don't think that's going to fix LSEG, but there we go.
No, the share price. But yeah, I haven't actually read the piece, so forgive me, Liam, please. But I do think that actually splitting it would make sense because it's too big. It's trying to do too many things.
Yeah.
You're trying to run the stock exchange. You're trying to run a data business. You're trying to, well, I think they're still trying to incorporate all of the Reuters icons that they bought donkeys years ago. It's unwieldy.
Yeah, I can speak firsthand what a nightmare that was because for those that don't know, Refinitiv bought Reuters, then LSEG bought Refinitiv, and then no one knew what was going on in any of that building. And like you were getting passed from pillar to post when you were trying to sign a deal with them. No one knew what department you should be talking to for the most basic of things. It was an absolute car crash. But yeah.
And while that was going on, the tech just kept breaking. I remember at the time we were using Icon at my old shop, and it was literally probably once every 3 or 4 weeks. Oh, we can't log in today. Oh, there's no pricing this morning. Well, what do you mean? Anyway, we've moved on from that, and we will move on as well. The last thing I did just want to mention in terms of the equity space from yesterday is the CME Group. They are continuing their product expansion. They are launching single stock futures. These products are going to enable participants initially to trade 50 of the top US stocks in the S&P and the NASDAQ, including names such as Alphabet, Meta, Nvidia, Tesla, basically all the kind of household names that you would expect. This is the latest line of new products from the CME, actually. I think it's very, very interesting that they are going down this route. Of course, thus far, they've kind of limited their product offering to the index level or sub-index level. So they're now drawing down into the single stock market. So it'll be interesting.
No, like you said, it's following the trend from CME, which is basically looking around, seeing what other markets are trading wherever, and going, well, hang on, there's a load of volume on that. We've got the best matching engines in the world. Why don't we offer those products in a regulated environment? And fair play to them. And it's covering everything now from prediction markets to sports. That you're doing US sports over there. Now you've got single stock futures. I think there's going to be more and more of this from the CME, and good on them.
Yep, agreed. I think they are very much going places.
Yes, very much so. Is that you good now? Is that done?
It is. Yeah, that's basically it from yesterday. As I said, not especially much going on. So we're going to I guess we're going to sort of wrap up our debate and the preview for the jobs report in one here.
Yes, no, absolutely. So obviously, as we know, it's now Jobs Day, NFP Day. Am I also right in thinking, and I'm only asking this, I'm sure I am right, but I've seen no one else mention it, which worries me because I'm like, this is quite significant, and yet I haven't seen anyone comment on it, and I apologise, Michael, if you have commented on it. But it's also Benchmark Day.
It is, and I have commented on it. So
there you go. Of course you have mentioned it. So for those this is perhaps why, in my opinion, we're being kind of guided that the numbers, we're going to hear horrific numbers, because from the last estimate I saw, the preliminary estimate back in September was for 911,000 jobs to be revised lower on this number, on this benchmark revision.
Yeah.
So it may sorry, go on.
Well, I was going to say, just to clarify, I think just before you go into that, because it is going to be quite significant later on, the revision that we're talking about here is nothing to do with the January report that we get today. It just so happens it's released in conjunction with it. And the way that the BLS work is that the annual revision is basically a tweak to the overall employment level as of March 2025.
Yeah.
So we are going back quite a fair way before Liberation Day, et cetera, et cetera. That's basically because they've needed a year to kind of tally up all the data.
Yeah.
But just so people are aware of what we're talking about here, we're talking, we'll get on to today's data in a second, but in terms of the annual benchmark revision, it's basically the BLS saying, we previously said that in March 2025, the overall employment level in the US was whatever it was, 160 million. We now think it is X number of 100,000 below that.
Yeah, well, this is the thing. And because it's likely to be such a huge number, I think we're going to get a lot of people jumping on that number rather than what today's NFP number will be, because it's going to look very, very shit. And I do wonder if that's what we're being kind of guided to prepare for, is this big, oh my God, nearly 1 million extra jobs weren't actually on the board. And it does, and sorry for me to be a broken record here, but this does play into what I've said many, many times before, that when a number is released, an NFP number is released, it gets revised straight off the bat the next 2 following months. And then every year we get a huge annual revision. So yeah, definitely one to watch in terms of when you're looking under the hood. Also, and this is one for the nerds out there, we do get the we do get the birth death model change also kicks in with this release as well, which means estimates are probably even more likely to be well off the mark. So an interesting one on that front.
Also, just before anyone gets the wrong end of the stick, that's births and deaths of companies, not of people, by the way.
Yeah. But as we know, and we've gone into this, why it's a bit random, the BLS, because it's like survey of a few businesses, etc. But yes, go on, take it away. What have we got to look forward to on just the headline number?
Well, yeah, exactly. We'll do payrolls and then we'll dig into the other parts of the report, because I think this will eventually take us back to a conversation we had a few weeks ago. In any case, headline payrolls seen having risen by 65,000 in the month of January. That would be just a tick higher than the 50,000 that we saw in December. As is pretty much always the case, the range of estimates for the payrolls print is frankly ridiculously wide, from minus 10,000 to the downside. I think that was Standard Chartered, to plus 135,000 on the upside. I think that was Santander. Obviously, the median falling at around that 65,000 mark. Leading indicators for the print are leaning on the soft side, if we're being completely honest. Not only have we had, as we alluded to, all of these administration officials kind of rolling the pitch for a bit of a poor report, you also look at things like the ADP employment metric. That pains me to say it, but as we said earlier, that rose by about 22,000 in January. Revelio Labs, they're putting together their own sort of alternative employment gauge. That pointed to employment having fallen by 13,000 in January. Initial and continuing claims did fall a little bit between the 2 survey weeks, but most of that was due to a seasonal adjustment. So I think that we can describe that more as noise than anything else. Just a couple of sort of factors that are worth bearing in mind in terms of the report. We typically see a big skew from seasonal adjustment in January. That is not anything nefarious. It's simply the case that what often happens is a lot of people are hired temporarily over the holiday season in December, and then once the holiday season is over, those temporary jobs that they did have no longer exist. So you do see a big factor in terms of seasonal adjustments skewing the number higher. The other thing just to bear in mind, obviously, we did have a very, very significant cold weather snap in the United States over the last couple of weeks. Ordinarily, you would say, is it going to impact construction, employment, et cetera, et cetera? Note that the cold weather came after the conclusion of the survey week. For anyone who is unaware, the survey week is the week containing the 12th of the month. Given that the cold weather came after that week, the BLS had already collected the data, so it's not going to be impacted by any of those weather effects. And just the last thing to watch in terms of factors around the data and digging into the details, this is something that I've been kind of harping on about for a while now. Pretty much all of private sector job creation in the US at the moment is coming from the healthcare sector.
Yeah.
In fact, if you take healthcare jobs out of the calculation over the last year in 2025, the US economy would have added just 20,000 private sector jobs. So the reason why this is important is because healthcare is not cyclical, it's not rate sensitive, it's effectively employment in the sector increases mechanically because more people are getting old, more people are getting ill, et cetera, et cetera. So I think it's very much a case of, yes, the headline numbers are important, but it's also going to be key to look at the details. Where is that hiring coming from? And also the revisions, not only the annual revision, but the prior 2 months worth of data.
And what do we say?
We always say.
Headline for show.
I'll let you say it.
Headline for show, revisions for dough. There we go.
Indeed.
Right.
Exactly that.
Gun to your head, what's your guess?
25.
Oh, I'm going 43.
Oh, that's very specific. Well, we'll settle that. Now it's going to come in 140.
Oh my God!
Isn't it?
If it now comes in at 43, I'm going to look fucking awesome.
Well, I'm going to have to buy you a beer as well,
No,
aren't I?
I think you will. But no,
So.
but just one thing to note as well, and I know we've mentioned it, we have done a proper dive into non-farm payroll and like kind of the methodology, etc. in the past. But for those unaware, remember, this is a really poor reflection of jobs data at the best of times because of the way it's surveyed, etc. Also, for those wondering, in case we see, unemployment and the unemployment number and the jobs number kind of not sync up and maybe go opposite ways, it's because unfortunately the unemployment number is based on completely different methodology. They just come out at the same time, completely unrelated to the BLS NFP data, to be fair. Many people don't
Yeah,
recognize that.
no, you are right. And actually, I'll come on to that now because the NFP figure comes from what we call the establishment survey, which is the BLS going and asking businesses about their payroll information. And that's where the earnings data comes from as well. Earnings expected to remain unchanged at 0.3% month on month. So we can kind of gloss over that. But the other statistics that we often look at, certainly at the moment, the statistics that matter more from a policy perspective, they come from what we call the household survey, which is, as the name might imply, the BLS going and asking households for their employment information. So you're absolutely right. And you will see quite often in terms of the aftermath of jobs prints, people going, well, NFP says this and unemployment says this. Why are they different? It's not a conspiracy. It's just how the data is collected. And they just happen to be lumped into the same press release.
Exactly that. You see like NFP data comes in like miles below expectations, yet but employment data, employment number, percentage actually goes the opposite way, and people are like, "Oh, this is proof that it's all a con." It's like, well, no, the methodology might be shit, but it doesn't mean the numbers are fixed. And I think there's a massive distinction between
distinction.
That's the one, between numbers being made up and just poor methodology. And I always lean, and I think you're the same. We always lean to they're not made up, and it's not like a government kind of conspiracy. It's just shit methodology, shit data gathering.
Yeah, the way I often frame it is it's more likely to be a cock-up than it is a conspiracy.
Exactly that.
Let's be completely honest. In any case, in terms of that household survey, unemployment is expected to have held steady at 4.4% in January, although we did get a low 4.4 in December. The unrounded figure was 4.375%. Labour force participation, meanwhile, that is expected to remain unchanged at 62.4%. Do bear in mind, as I've kind of alluded to a second ago, that policymakers on the FOMC, they at the moment are placing a lot more weight on the household survey than they are on the establishment survey. One of the reasons why they stood pat and adopted this kind of wait and see approach at the January meeting was because of the stabilization that we saw in the unemployment rate. Powell and his colleagues don't particularly care about payrolls growth. What they're more focused on is the degree of slack within the labor market, not only in terms of the inflationary implications or lack thereof, but also in terms of achieving that maximum employment side of the dual mandate. You gauge maximum employment by looking at unemployment and participation, not by how many jobs the US is adding on a monthly basis. Speaking of the Fed, money markets, as of about 10 minutes ago, when I left the desk to go and do this recording, were pricing about a 1 in 5 chance of a 25 basis point cut at the March meeting. We have seen a bit of a dovish repricing there since the retail sales figures that we had yesterday. The next 25 basis point cut is not fully discounted until June. And of course, the June meeting is pretty much certain to be the first meeting that chair designate Kevin Warsh will chair, which is why we do see quite a significant, I guess what you'd call a bit of a kink in the curve, where markets are suddenly pricing a lot more cuts after June. Also, do bear in mind that although markets will obviously be jumping around all over the place on the data that we get at 1:30 London, 8:30 this morning on the East Coast, we will be getting not only the February jobs report, but also the January and the February CPI figures before the March FOMC meeting. So no matter what the data says today, FOMC policymakers are not going to overreact to one single data point, especially when they have plenty more data coming before they next have to make a call on policy. So do just bear that context in mind. Although markets may go in one extreme or the other, policymakers on the FOMC are not going to overreact to one report, whether it is incredibly hot, incredibly cold, or somewhere in the middle. They are going to look at the totality of the data that's available by the time they get to their next meeting.
Well said, that man. There's not really much to talk about going forward for the rest of the day, is it? It's all on the jobs number, really.
No, not really. I mean, that is literally it, to be honest with you. There's a 10-year Treasury auction this evening. The 3-year sale went pretty well yesterday. There's a few earnings. McDonald's probably the highlight there. But it is really all about the jobs report today. So you'd expect, as we're kind of seeing now, just a bit of a choppy, indecisive morning, at least here in Europe. And then things might kick up a gear once we get that data at lunchtime.
Absolutely. Well, on that one, Michael, thank you so much as always. Listeners, thank you so much as always. I hope we've added a bit of value to your day, put a smile on your face, etc., etc. Shout out to, obviously, our good friends Zach, Tom, Liam and Clive. And